Canada's economy just shrank by more than economists expected. Exports are down, growth is negative, and US tariffs are clearly biting. But there is a bigger story here because while this contraction is real, it's unlikely that it's permanent, and it's not even unexpected. It also comes at the same time as Canada is quietly building something very different behind the scenes. Let's break this down calmly and clearly, starting with what these numbers actually mean. Before we get into it, let's do a quick question. We're going to be talking a lot about GDP in this video, so before we do all of that, what is one alternative to GDP for measuring a country's economic well-being? Gross National Happy Index, Purchasing Power Parity, Consumer Price Index, your own ideas? Take a second, drop your guess in the comments, we'll circle back to this towards the end. You've probably already seen the headlines that say Canada's economy just shrank by 1.6% this quarter, but what does that actually mean? Let's cover this very briefly before we get into why it happened. When economists say that the economy shrank, they're usually talking about GDP, gross domestic product. It's essentially a measure of the total value of all the goods and services a country produces. So when GDP goes down, it means that overall there is less economic activity. Fewer things are sold and bought. There is less investment into things. We're exporting fewer things outside of the country. In the second quarter of 2025, Canada's GDP fell by 1.6% annualized. That means that if this pace continued for a full year, the economy would be 1.6% smaller. This is a very significant number. It's not catastrophic, but it is sharper than expected, because economists had forecast a 0.6 decline, and instead we got something almost triple that. It also follows a 2% decline in the first quarter this year, so this is 2 consecutive quarters of contraction, which is the classic technical definition of a recession. But let's pause before we panic, because Canada's biggest trading partner is still the United States. And in 2025, under the Trump administration, new US tariffs were imposed on Canadian exports, especially in cars, steels, and aluminum. Now, tariffs are often described as tools for protecting local industries, but the thing is, they're still taxes. They make imported goods more expensive, which means fewer people buy them. And if you're a country that exports those goods like Canada, you lose business, and that's exactly what happened. Canadian exports fell by 7.5% in the second quarter of 2025, and the exports of cars and light trucks dropped by nearly 25%, which is a massive hit since auto manufacturing is one of Canada's most important export sectors. As Royal Bank of Canada economist Nathan Johnson put it, trade-exposed sectors have weakened, business investment fell. That's largely as expected. In other words, this was predictable, not painless, but predictable. Because tariffs are designed to reduce trade flow, and that's exactly what the numbers are showing. But that's only one part of the story. Hold on. If you want to support this kind of calm, structured analysis, there's a Ko-fi link below. Every contribution helps. Now, to be clear, this kind of short-term economic pain isn't a surprise, but it is a part of a trade-off. Tariffs function like a tax on trade, and taxes create friction. That friction slows things down, fewer exports, fewer business deals, more uncertainty. And when you're dealing with your largest export market, as Canada is with the United States, that impact is magnified. But it's important to understand that this wasn't a failure of policy planning on Canada's part. This was something Canada saw coming. In fact, Prime Minister Mark Carney even removed Canada's retaliatory tariffs in hopes of easing tensions with Washington. But he also made it clear that the long-term solution wasn't reconciliation. Instead, he appears more focused on realignment. Carney's election platform made that explicit. They said, make Canada the strongest economy in the G7 by reducing overreliance on the US. And diversification is a beautiful and wise idea, but we're talking geopolitical partnerships of countries, and those take time to change. And while they're changing, short-term drops in GDP before the benefits of new partnerships are visible and expected. Behind the scenes, Canada has been quietly reshaping its place in the global economy. Over the past few months, it's been deepening its ties with countries like Germany, Sweden, Finland, Denmark, and the broader European Union. Now, these aren't exactly the kind of flashy announcements that make headlines. They don't dominate the news cycle the way tariffs or political spats do, but they're just as important and arguably more enduring. What Canada's doing here is super strategic. We're seeing long-term coordination in everything from critical minerals, which are essential for batteries, electric vehicles, and clean energy tech, to defense procurement, high-tech manufacturing, clean infrastructure, and even research industry alignment. Think of it this way. Canada isn't just finding new customers, It's building entire supply chains, diplomatic pathways, and regulatory frameworks that don't rely on a single country's mood swings, especially not one as politically volatile as the US has been recently. In economics terms, this is called trade diversification. But what that really means in plain English is spreading your risk. It's like what any sensible investor does. You don't put all of your money in one stock, especially if that stock has been acting a little erratic lately. Canada has basically learned from experience. For decades, its economy was deeply integrated with the US, and for good reason. The geographic proximity, the open border, the long-standing agreements. But when tariffs can appear almost overnight, an entire industry get caught in the crossfire of political cycles, the cost of over-reliance becomes very real. So this realignment toward Europe, toward the Nordics, toward multilateralism, it isn't just short-term reaction. It's a conscious decision to build a different kind of economic architecture, one that's more stable, more resilient, more sovereign. Of course, these kinds of changes don't show up in the GDP figures right away. You don't negotiate a defense partnership or a research to manufacturing pipeline in Sweden and then see your growth numbers spike the next month. These agreements take time. Infrastructure takes time. Trust takes time. That's the nature of structural pivots. The early months can feel like decline, even when you're laying down the foundations for something bigger. Basically how your muscles hurt after you've been in the gym for the first time, even though you're actually building a better life for yourself. And the numbers we're seeing now reflect the aftershock of the tariff wave, not the impact of new alliances. That impact is still unfolding, but it is real. If you want to dig deeper into this, I've made full videos on exactly these shifts. One explores Canada's evolving relationship with the EU and the long-term implications of the CETA agreement. Another dives into the CPTPP, that's Canada's Pacific-facing strategy and how it fits into this diversification push. And there's also a breakdown of how Canada is working with Sweden, Denmark, and Norway, not just diplomatically, but in defense, innovation, and Arctic cooperation. You'll find all three linked in the description below, and if this is your first time thinking about economic resilience in a global context, it'll give you a fuller picture of what Canada is actually building and why it matters more than just one quarter's GDP. If you're enjoying this, I'd love it if you subscribe. The House of L is a community of thoughtful, curious people, and you're very welcome here. Here on House of L, we always try to have balanced arguments, and this discussion would be incomplete without remembering, especially when headlines are dominated by GDP figures, that GDP isn't everything. Yes, it tells us the size of the economy, the total value of all the goods and services produced in a given period. It gives us a sense of whether things are expanding or contracting, but what it doesn't always tell us is how resilient the economy is, or how well positioned it is for the future. GDP is a snapshot, and like any snapshot, it can miss what's just outside the frame. Take this quarter, for example. If the economy shrinks because exports are down, that looks bad on paper. But what if those exports drop because the economy is actively rebuilding its supply chains or repositioning trade away from volatile partners towards more stable ones? That's not a policy failure. It's more like a strategic transition that hasn't yet shown up in the data. All investments, by definition, involve short-term costs before long-term benefits kick in. GDP also doesn't immediately reflect when infrastructure is being built. If Canada is developing new logistics corridors to trade with Europe or enhancing its defense manufacturing capacity through Nordic partnerships, that doesn't hit the GDP numbers right away, but it still matters. Its real economic progress is just a little delayed in the data. Another example is consumer spending. Despite the overall contraction, consumer spending in Canada actually held up better than expected this quarter. That's a sign of confidence. It suggests that households still feel stable enough to spend, which is often one of the first things to drop during true economic distress. So I think what we're seeing here is a short-term dip in output, but a medium-term build-up in economic capacity. Economist Robert Aslan calls this short-term pain, and that's exactly right, not because it downplays the damage, but because it acknowledges that there is a strategy behind it. The goal here is bigger than just fixing this quarter's numbers. It's about building sovereign capabilities, designing industrial policy that actually aligns with Canadian research and innovation, and setting up the economy to be less dependent, more diversified, and more durable. If that means a temporary dip in GDP, that's a trade-off worth making, I think. Because in time, once the infrastructure is in place, once the trade flows begin to shift, and once the investments start producing returns, GDP will catch up, but resilience comes first. As for that question from earlier about alternative ways to measure economic growth, one increasingly cited alternative to GDP is gross national happiness. It was originally developed in Bhutan. It tracks well-being, sustainability, and cultural preservation. It's not perfect, nothing is, but it reminds us that not all value is economic. I'm considering making a separate video on the issues of GDP as a metric and its alternatives, so if that sounds interesting, please let me know in the comments so I know that there is an interest. Anyway, yes, Canada's economy shrank this quarter, but none of this is a surprise. Tariffs are a known cost. Canada's current contraction is painful, but it might also be a turning point. GDP is down, but if sovereignty, redundancy, and trade resilience go up, that's a deal many countries would take, right? I guess everyone's trying to achieve the same thing. If you'd like to understand how these tariffs are affecting the USA, because they're also not having the best time, check out this other video that I'm linking here. We explain everything there: tariffs, the dollar as a reserve currency, and more. Until then, remember, a shrinking economy isn't always a sign of weakness. Sometimes it's just the sound of a country shifting gears. I'll be watching how Q3 and Q4 numbers unfold, not because GDP is everything, but because direction matters more than speed. With recession-proof regards, this is House of L.